In early 2026, something unusual started happening inside the American financial system. It wasn't loud. It wasn't announced on television, but behind closed doors, inside banks, hedge funds, and government advisory rooms, one question kept coming up again and again. Not if crypto mattered anymore, but which one mattered more, Bitcoin or Ethereum? For years, the public conversation focused on price. Bitcoin is up. Ethereum is down. Bull run. Crash. But institutions in the United States were no longer talking about price. They were talking about control, infrastructure, and survival. Because by 2026, Bitcoin and Ethereum were no longer just cryptocurrencies. They had become competing financial philosophies, and the U.S. financial system was paying close attention to both. Bitcoin had done what it always promised. It survived multiple market crashes, regulatory pressure, exchange failures, political attacks. And by 2026, Bitcoin was no longer viewed as an experiment. It was viewed as digital hard money. Pension funds in the U.S. didn't call it risky anymore. Insurance companies didn't call it speculative anymore. They called it what it had quietly become, a hedge. A hedge against inflation. A hedge against monetary expansion. A hedge against political uncertainty. Bitcoin didn't change itself to fit the system. The system slowly adjusted around Bitcoin, and that made it powerful. But Ethereum took a completely different path. While Bitcoin focused on being money, Ethereum focused on becoming infrastructure. By 2026, Ethereum was no longer just a blockchain. It was a settlement layer. Banks weren't asking whether Ethereum was safe. They were asking how much of their operations could be automated on top of it. Smart contracts weren't a buzzword anymore. They were being used to settle trades, manage collateral, issue digital bonds, and move value faster than traditional rails ever could. And this created a quiet tension. Bitcoin was becoming the digital reserve asset. Ethereum was becoming the digital operating system. And the U.S. financial system realized something uncomfortable. They might need both. Bitcoin represented stability through scarcity. Ethereum represented efficiency through programmability. One protected wealth, the other moved wealth. But here's where it got interesting. In 2026, regulators stopped asking, how do we stop crypto? They started asking, how do we integrate it without losing control? Bitcoin was easy to understand but hard to influence. Ethereum was flexible but harder to predict. Bitcoin had no leader. Ethereum had upgrades, governance debates, and developers shaping its future. And for the U.S. financial system, that difference mattered. Because control is everything. Bitcoin doesn't ask permission. It doesn't adjust to political pressure. Its rules are slow to change, and that's the point. Ethereum, on the other hand, evolves. It upgrades. It adapts. And that adaptability made institutions nervous and excited at the same time. By 2026, U.S. banks were no longer asking if blockchain technology would replace parts of the current system. They were asking which blockchain would dominate which role. Bitcoin was being treated like digital gold. Ethereum was being treated like digital infrastructure. But the average American didn't see this shift. Most people were still focused on headlines, on short-term price movements, on social media hype. They didn't realize that behind the scenes, financial power was quietly repositioning itself. And that's why this comparison matters. Because Bitcoin versus Ethereum is not a competition about price charts. It's a competition about what kind of financial future the U.S. is building. A future where money is untouchable but rigid. Or a future where money is programmable but controllable. By 2026, institutions weren't choosing sides publicly. They were hedging privately. Bitcoin for long-term value preservation. Ethereum for financial automation and innovation. And this dual approach revealed something important. The U.S. financial system wasn't betting on one winner. It was preparing for a split reality. A world where Bitcoin exists outside the system, and Ethereum operates inside it. But that balance is fragile, because if Ethereum becomes too powerful, it risks becoming centralized through regulation. And if Bitcoin becomes too widely adopted, it threatens the very control central banks rely on. This is why both assets are being watched so closely. Not because of their prices, but because of what they represent. Bitcoin is resistance through mathematics. Ethereum is efficiency through code. And in 2026, the U.S. financial system understands one thing very clearly. It can't ignore either anymore. Because whichever one dominates the next decade will quietly reshape how money, power, and trust flow through America. And this is only the beginning of the story. Because once institutions start choosing how to use Bitcoin and Ethereum, the consequences reach far beyond Wall Street. They reach everyday Americans in ways most people don't expect. That's where the real difference begins. By 2026, the most important shift wasn't happening in public markets. It was happening in policy rooms, balance sheets, and quiet pilot programs. The U.S. financial system had reached a point where ignoring crypto was no longer an option, but fully embracing it wasn't safe either. So instead, institutions did what they always do best. They experimented quietly. Bitcoin ETFs had already normalized Bitcoin's presence inside traditional finance. It sat on balance sheets. It appeared in retirement portfolios. It became something Americans didn't have to believe in anymore. They just owned it. But Ethereum was different. Ethereum wasn't being held. It was being used. By 2026, several large U.S. financial institutions were testing Ethereum-based settlement layers, not for speculation, for efficiency. Clearing and settlement, which once took days, was now being tested in minutes. Smart contracts were replacing paperwork. Middlemen were quietly removed from processes they once controlled. And this raised an uncomfortable question. If Ethereum could automate trust, what happens to institutions whose entire business model depended on managing trust? This is where fear entered the conversation. Not fear of price volatility, fear of irrelevance. Bitcoin didn't threaten the internal structure of banks. It sat outside the system. Ethereum threatened how the system functioned, and the U.S. financial system noticed. Ethereum upgrades over the years had made it faster, more scalable, and more energy efficient. Transaction costs were no longer the barrier they once were. Layer 2 solutions had turned Ethereum into a network that could handle real economic activity. That's when Wall Street stopped asking, "Is Ethereum safe?" and started asking, "Who controls it?" Because control is the currency of modern finance. Bitcoin's strength and its rigidity made it predictable. Ethereum's strength, its flexibility, made it powerful, but dangerous. Ethereum could be shaped, upgraded, adjusted, influenced, and for regulators that made it attractive. By 2026, U.S. policymakers were far more comfortable working around Ethereum than Bitcoin, not because they trusted it more, but because it was negotiable. Ethereum developers could propose changes. Institutions could participate in governance conversations. Compliance layers could be built on top. Bitcoin offered no such compromises. Its rules were fixed. Its issuance was untouchable. Its network didn't respond to political pressure. That made Bitcoin trustworthy and uncontrollable. And in finance, uncontrollable assets are tolerated, not embraced. So the system made a quiet distinction. Bitcoin would be treated as a store of value. Ethereum would be treated as a financial tool. This distinction shaped everything. In 2026, major U.S. banks weren't racing to replace the dollar with Ethereum. They were racing to make the dollar faster, cheaper, and more programmable using Ethereum-like infrastructure. Tokenized assets became normal. Stocks, bonds, real estate exposure, all represented digitally, all settled through code. Ethereum wasn't replacing finance. It was upgrading it, and that's what made it dangerous. Because upgrades come with dependencies. Once institutions rely on Ethereum-based infrastructure, they rely on developers, validators, and networks they don't fully control. This is where the tension sharpened. If Ethereum became too embedded, the financial system risked losing sovereignty over its own rails. If it rejected Ethereum, it risked falling behind faster, more efficient global systems. So the U.S. financial system did what it does best. It tried to shape the outcome. By supporting Ethereum-compatible systems, by encouraging compliance-friendly layers, by steering innovation toward permissioned environments, Ethereum didn't resist. It adapted, and that adaptation raised a philosophical divide. Bitcoin users argued that Ethereum was becoming too close to the system it once aimed to disrupt. Ethereum supporters argued that integration was the only path to real-world impact, and the U.S. financial system watched both sides carefully. Because from their perspective, this wasn't ideology, it was strategy. Bitcoin offered protection against monetary mismanagement. Ethereum offered control over financial flows, and both had value. But here's what most people missed in 2026. This wasn't a zero-sum competition. Bitcoin and Ethereum were solving different problems. Bitcoin answered the question, how do we protect value in a world of unlimited money creation? Ethereum answered the question, how do we move and manage value in a digital economy? The U.S. financial system didn't need to choose one. It needed to balance both, and that balance revealed something deeper. Power in the future wouldn't belong to the loudest technology. It would belong to the technology that integrated quietly. Bitcoin gained power by refusing to change. Ethereum gained power by changing constantly. And by 2026, that difference shaped how each asset was treated behind closed doors. Bitcoin was respected. Ethereum was negotiated with. And that negotiation wasn't finished. Because as Ethereum grew more central to financial operations, the risk increased. What happens if Ethereum governance changes conflict with U.S. financial interests? What happens if validators concentrate? If regulation reshapes incentives? If decentralization weakens? These weren't theoretical questions anymore. They were planning scenarios. And while institutions explored Ethereum's potential, they kept Bitcoin close as insurance. Insurance against system failure. Insurance against overreach. Insurance against loss of trust. By 2026, this dual strategy had become clear. Bitcoin for resilience. Ethereum for efficiency. But this balance wouldn't last forever. Because the more Ethereum integrates with finance, the more pressure it faces. And the more Bitcoin grows as a reserve asset, the more it challenges existing power structures. Which means the next phase wouldn't be quiet. It would be visible. And it would affect everyday Americans in ways few people were prepared for. That's where this story moves next. By the time 2026 moved into its second half, the consequences of this quiet shift were no longer abstract. They started showing up in real life, not in headlines, not in crypto Twitter debates, but in how money quietly behaved for everyday Americans. Bitcoin's role as a long-term reserve asset began influencing institutional behavior. Companies didn't trade it daily. They held it. It sat there, untouched, as protection against uncertainty. And that alone changed incentives. When large institutions stop rushing to sell, volatility slowly declines. When volatility declines, confidence grows. And when confidence grows, Bitcoin stops being viewed as a gamble and starts being viewed as infrastructure level. Money. That transition mattered. Because money that doesn't move often becomes power. Bitcoin wasn't being used to buy coffee. It was being used to anchor balance sheets. And that's exactly what made regulators uncomfortable. Bitcoin's independence meant it couldn't be paused. It couldn't be edited. It couldn't be redesigned to fit political needs. Ethereum, on the other hand, continued its integration. By 2026, Ethereum-based systems were quietly supporting parts of lending, settlement, and asset tokenization, not visible to consumers, but essential behind the scenes. And this is where the real-world divide became clear. Most Americans interacted with Ethereum-powered systems without realizing it. They didn't need to hold ETH. They didn't need a wallet. The system used Ethereum, not the people. And that distinction changed everything. Bitcoin empowered individuals directly. Ethereum empowered institutions indirectly. One gave sovereignty. The other gave efficiency. And the U.S. financial system leaned into both. Carefully. But here's the part no one talks about enough. Efficiency always comes with trade-offs. As Ethereum-based automation expanded, decision-making became more algorithmic. Loans, collateral requirements, liquidations, all triggered by code. And while that removed human bias, it also removed human flexibility. In times of stress, code doesn't negotiate. It executes. This raised new questions in 2026. What happens when automated financial systems collide with real-world crises? What happens when smart contracts act faster than regulators can respond? Ethereum wasn't dangerous because it failed. It was dangerous because it worked too well. Meanwhile, Bitcoin remained stubbornly simple. No automation, no central upgrades, no shortcuts. And that simplicity became its strength. When systems failed, Bitcoin didn't adapt. It endured. That endurance gave it credibility. By 2026, financial advisors in the U.S. no longer framed Bitcoin as high-risk crypto. They framed it as asymmetric insurance, something you don't hope to use, but are grateful to have. And this difference shaped how Americans slowly began to think about money. Not consciously, but behaviorally. People trusted Bitcoin to exist. They trusted Ethereum to function, and trust is the most valuable currency of all. But the biggest shift came from one realization. Bitcoin and Ethereum weren't competing for dominance. They were competing for dependence. Bitcoin asked nothing from the system. Ethereum required participation, and the more institutions depended on Ethereum, the more leverage Ethereum gained. That leverage made regulators nervous, because leverage cuts both ways. By late 2026, policy discussions shifted again, not about banning crypto, not about embracing it fully, but about containment. How do you contain a system that runs on open networks? The answer wasn't restriction. It was integration. Build compliant layers. Encourage permissioned environments. Guide innovation without stopping it. Ethereum fit that model. Bitcoin didn't. And that's why Bitcoin remained outside. Respected, watched, but never fully welcomed. And that outsider status preserved its power. This is where the long-term implications become clear. Ethereum will likely continue to power financial infrastructure. Invisible, efficient, deeply embedded. Bitcoin will continue to sit above the system. Untouchable, scarce, politically neutral. And Americans will live between these two realities, using systems powered by Ethereum. Saving value anchored by Bitcoin, not because they chose sides, but because the system did. And that brings us to the most important insight of all. The future of finance in the United States isn't about replacing the old system overnight. It's about layering new systems quietly. Bitcoin is a foundation of trust. Ethereum is a foundation of function. One protects against failure. The other optimizes success. And both are being watched closely. Not because they are dangerous, but because they work. For everyday Americans, this means one thing. Understanding crypto is no longer optional. Not because you need to trade, not because you need to speculate, but because the systems shaping your money are changing, whether you participate or not. Bitcoin and Ethereum aren't just assets anymore. They are signals. Signals of how power, value, and control are being restructured. And in 2026, the smartest move isn't choosing a side. It's understanding the role each one plays. Because the future won't belong to the loudest believer. It will belong to the people who understand the system early and position themselves calmly. That's the real story behind Bitcoin versus Ethereum. Not hype, not price, but quiet influence. And that influence is only growing.